following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
Welcome back to the Option Block. We are, of course, your bi-weekly source for all things options related. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding Options Insider Radio Network. And if you haven't checked out our latest addition to the network, I encourage you to do so. You can surf on over to theoptionsinsider.com or just search for the wide world of options in your podcast player of choice, iTunes, Stitcher, TuneIn, what have you. And you can check it out for yourself. It's hosted by our friends over there at the Options Industry Council. And as the name implies, it is a very wide-ranging look at the world of options. But for today's program, we have once again assembled an all-star panel for you, starting off with the man beaming in from the great town known as St. Charles, Illinois. He is none other than Uncle Mike Tusaw from RCM Asset Management. Uncle Mike, welcome back to the show. Sir, it has been too long.
Oh, it's always a pleasure to be here.
We missed you last week, so now we need to get a double dose of Uncle Mike in for all of those listeners who wrote in saying, where is Uncle Mike? Where was he? So you have to talk the entire show, and I'll just sit back this time.
Both of the people that wrote in, huh?
Your mom and I believe it was your cousin.
Something like
both
that.
Both are very sad. Both are very sad not to hear you on the show.
Aw, poor mom.
All right. And also beaming in from far, far away, but from my current time zone. So we're time zone brethren, if not else, Andrew. He is Andrew Giovinazzi from OptionPit.com. Andrew, welcome back to the show, sir.
Thank you, Mr. Longo. I do prefer the term time zone homies. We are time zone homies now.
We are time zone homies for another 24 hours at least.
You know, I must have watched 20 episodes of Breaking Bad, back to back. That's totally ruined now by that.
So now, after we finish up this show, you're heading off to Albuquerque to start up a meth lab. That what you're saying?
Well, hey, you know what I hear? The problem is a lot of risk in that business. Speaking of risk, that was your segue, Mr. Longo.
Yes, as my segue to keep on moving to our final cheer on the old all-star panel today. You know him, you love him. He is the Viceroy. Some of you come up to him while he's dining out and regale him with tales from this show. He is Alex Jacobson from Options Express. Alex, welcome back to the show, sir.
Hey, Mark, thanks. Today was another day where I tore up my notes 10 minutes before and then I pieced them back together at the close. Another interesting trading day.
I had the exact same scenario unfold for me. I started planning the show a little bit earlier today because I am ostensibly on vacation. And then I saw, oh, wow, another strong rally. And then, bam, the narrative shifts. So I think instead of discussing it here, we'll just keep on rolling right on into the trading block.
The trading block.
All right, and welcome to the trading block. This is, of course, a portion of the show where we discuss what was trading, what was moving ye old markets today. And as Alex alluded to, it was an interesting one. Earlier in the session, we were up, most of the major indices were up about 1% on the day or so, or hovering around that level. Fast forward a few hours, and most of those gains were eked away. Most of the indices were up fractionally on the day, if that. And now fast forward yet again to the close, and most of the indices are back up essentially on the day, closing near that 1% level. S&P up about 12.5 handles to 1639 on the day. Had been up only a couple as recently as it's an hour or so ago. So it got some steam back in its own, or got some air back in the old sails towards the end of the day. The Dow up about the same amount, 215,179. And the NASDAQ also up about 0.75 of a percentage point to 34.52. A crazy day on the old streets. It seemed like everyone and their mother was in love with the market ahead of the big Fed announcement later this week. And yet that love the bloom seemed to come off the rose pretty aggressively towards the middle of the session, and then once again everyone was in love with it. So it was an odd one today. I don't know where to start. Maybe we'll start with you, Andrew. Why don't you piece together your narrative of what you saw unfolding today and in this very odd, somewhat schizophrenic market that we saw today?
Well, I'll tell you what. Mostly, one thing, all day long we basically opened up 1% because the Fed might do something. I think that was kind of the news, right? That the Fed might do something Wednesday, so we had the huge I felt like more like a relief. Like last week had some kind of bad juju on it. So new week, so possibility that the Fed might. I think the Fed's already said they're gonna taper toward the end of the year or something like that, or along those lines. Tapering's in the cards, so which I believe is still a good thing because we want the Fed out of the economy as much as possible, but. It is driving that short-term volatility. And we had a rally today with not a real decline in implied vol. The VIX was only down. It opened down and spent the rest of the day rallying until just the end of the day. So normally, if you really don't get that fall in vol, at least from a trading point of view, we traded. VIX cash traded 1760 something today for a high, like 1760 or so. It opened at 1630, so like 1.5, about 1.3 point move, which is pretty good. So it's again Fed watching. It's not a market I want to sell. Maybe have a little bit of positive decay, but not a huge amount, and kind of wait to see how things shake out. But ultimately, the Fed they said they're going to get out of the market kind of on a slow crawl, and they probably will. So, the economic data here is still, I think, improving. I think the housing number today was pretty phenomenal. And I think what caught the market by surprise, and I'm not sure if this hit the tape earlier, the U.S. and the EU might try an Atlantic, like a North Atlantic free trade agreement, something like that. So I'm still watching. I'm still trying to find that news, which might have caused kind of the reversal, but I'm not sure. I was just looking here at the end of the day. I'm like, what's going on? So I try not to watch too much news during the trading day, and because that's sort of dangerous to your health. But yeah, I still think we're going to have these same kind of up and downs, and the market is going to take a while getting used to the Fed getting out of the economy. So I think we're going to see this type of action, more and more frequently. Up 1%, down 1%. That kind of smoothie free ride we had at the beginning of the year I think it's going to be a little rougher. It doesn't mean we can't go higher. It's just I don't think we're going to get that launch pad effect that we had before.
Yeah, days like today are always strange beasts because we're rallying off very, ethereal potential action. Nothing's really happened that's concrete yet. So we're rallying ahead of this, potential notion that the Fed might do something later this week. And then, of course, the rally comes off for some pretty much unknown reason. It could be what you just talked about, Andrew, but you're right. I tend to subscribe to the same thing of ignoring most of the news during the day because it's pretty much nonsense. And then at the end of the day, we got the love again. So it was an odd one. Uncle Mike, how was the BBI today? Were you glued to your chair for most of the day with all of these kind of schizophrenic swings going on in the broad market?
Well, BBI today was just at a stage where I think that a lot of the initial move came before the market. So theoretically, the BBI was, even though it wasn't, it was just kind of staring at the futures and pre-market, wondering what the heck's going on. But for the most part, earlier in the day, not a lot in terms of what's happening. I saw gold came down a little bit, probably about 0.5%, but that's not really a ton of movement. One thing that I did notice today is that with on the treasuries, I'm just looking at TLT, the ETF that trades the longer term treasury securities. That's down a little over 0.5% today, which isn't a huge amount of movement for it either, I guess I should say. And the same holds true with IEF. So with that, I think just bottom line is that we're all kind of waiting around for what's going to happen at 1 o'clock in our time zone. Alex is my time zone homie today. 1 o'clock in our time zone come Wednesday to see what's going on. And we're not going to get a clear picture until we hear what the Fed has to say and the press conference to follow.
Yeah, it was a difficult one. I was going to ask you about the gold. I'm glad you brought that up because gold has had a bit of a run to the downside the last couple of days, down about 0.5%, like you mentioned today, sold off again yesterday. Again, all of that pretty much in anticipation of what's going to happen on Wednesday. So how have you been positioning out there in gold? Are you still, I know you were writing some puts out there. Are you still actively doing that? You keeping your powder dry? Are you, I know you actually had for a while there, you were also letting the collars go with no covered call components. What's the current approach here in GLD?
Current right now, we're still long a protective put, but what I plan on doing tomorrow or early morning Wednesday, combining a protective put, and this is the same with silver also, and then with a longer term combined with some type of calendar action as a way of financing it, or financing some, or as, how can I put this, balancing the theta, so to speak. It'll take extra cash to do so, so it's not going to be a per se costless trade. So there will be some extra cash needed, but I really don't want to cap the upside at this point just because we've been kind of hanging around this level for so long. But on the flip side, it would be foolish and very financially non-prudent not to hedge the downside with the positions with which we have. I always view gold and silver. It's kind of like watching option football. They're going to run the dive 26 plays in a row, bore you to death with a 3-yard gain at most, and then all of a sudden, when you're least expecting it, they throw a long pass and surprise you. Silver, we watched silver do that a couple of years back, and we even talked about it on the show a lot. Silver, it just kind of did not move for a while, and then all of a sudden, one day, it's up 1,000,000%. So I don't really want to cap the upside because of that fact, because they've been running the dive a lot the last few weeks or months, I should say. But on the flip side, who knows? This might just be a little bit of a break, and we might totally crap the bed in both metals, and then you never know. So the way with which I'm playing it is I'm going to be using a calendar spread with extra capital that we have to finance the protective puts.
And Alex, what caught your eye over there at OX today while you were writing and then rewriting and then rewriting again your script for the show today?
So as I was commuting in this morning, I was listening to a Bloomberg report, and I think that indicates what a boring life I lead.
I was going to make the joke. I'm glad you did it for me.
They talked about the fact that in the last 10 trading days, the range in the Dow has been, on average, 191 points, which is a 20% average realized vol. And tradition in my lifetime, when realized is bigger than implied, markets like that. We've talked a little bit how low implied seems to precede stuff. But when realized is bigger than implied, that's not that common of an event. I also think that explains why VIX hasn't broken down as much on these up days because realized has been so big. I know my buddy Don Schlesinger would school me on this. But I'll tell you what was keeping us busy here today was everything. And I know that's kind of a corny thing to say, but it was, green lights pretty much on every common option name that we've been trading a lot lately, with the exception of Lulu. Lulu was the only red light today. And there was a little love in the minis. We do a big job in the minis between ourselves and our parent, Schwab, because I think amongst many of the firms, we were out front with a lot of the research and a lot of the ability of it. And saw some love today in gold minis and Apple minis. Little bit of Amazon today, not a ton. Amazon has not had the best liquidity in the minis, and the minis overall are still not as liquid as I think we would all like them to be. But, listening to phone calls today, it was Google, it was the Intercontinental, the other ICE, and it was Netflix and Priceline today. So it was a pretty typical option day. But as I said, or as you pointed out, Mark, actually we've all talked about it, little schizophrenia today. It's like, watching the Daily Show where Jon Stewart starts throwing his notes around, screaming. But the macro news was good. We're all going to look at the Fed. We're all waiting for Wednesday and what Bernanke has to say.
Now, I'm glad you brought it up here. I was going to save it for the Xpress Block where we can touch on it since you hit on it already, is, of course, the minis. I was going to ask you in the Xpress Block if they're getting up to snuff with what you guys anticipated, with what a lot of people in the industry anticipated a few months ago back when they were launched. Sounds like they still have yet to turn that corner. Obviously, the minis and Apple getting some traction because they've kind of been where the bulk of the promotion and marketing and stress has been. But still sounds like the minis are nowhere near what a lot of people, myself included, anticipated after the year-long ramp-up to this amazing new product that was going to revitalize the entire business. Sounds like we're still a long way away from that.
Yeah, I agree. I mean, I was looking at let me sort of go back a step. One of the cool thing about the minis is, at least in the two shops up here, in the OX and the Schwab shop, it is bringing in that smaller trader. And that's both a good thing and a problematic thing, because from a sort of a regulatory standpoint, you'd like to see smaller traders hedging and doing things of that nature. Not sure I want to see, the 3-lot mini trader maxing out the SMA in their account to do some, Apple condors or things like that. I think they should walk before they run. But I was pricing an Apple condor today, and the full-size option market was something like 320, 360, and the mini, the market was still like $294. And to your point, the exchanges need to do a better job. The community that provides liquidity needs to do a better job. I think the thing that's lacking in the mini at this point is still a big enough ecosystem. And if it's really going to become a robust success, it isn't just a handful of brokerage houses supporting it and, Citadel and Timber putting it on their machines. And I'm guessing marking it, 2 ticks worse than the full size. It's got to be the same quote if it's going to work, and it's not there yet. It's better than it was a few weeks ago, but there's still room for improvement.
Don't you think the quote size has to be better, Alex, for it to fly, really?
It's catch-22. It's
only 1/10 the size. I mean, for a pro trading firm, I mean, there's no gamma in the product, so it's not, I don't know. In order to attract, I'm just saying to attract volume, to get, it's just, there's less risk in the products themselves. But if they're making them wider than the ordinaries, it's going to be tough. But yeah. I mean, but in reality, market makers are there to make money, and if they're trading 2 ticks wider than the ordinaries, then that's where they're going to trade.
Yeah, I think, and what I'm hoping is the evolution will occur where right now the people who were prepared in the minis were the Citadels, the Spears, the Timbers, and I'm sure I'm leaving somebody out. But I think some of the smaller firms that trade on their purchase trading system as opposed to writing their own trading system, I think some of the smaller firms would want to be there because, as I say, there's more room in the markets. I just don't think their technology is there yet, and I'm hoping as the ecosystem builds, I guess I'm also hoping that the ecosystem does, do the homework to do this stuff. It gets better, but I mean, if the market in the big one is 320, 360, and the market in the little one is $294, then the little one is doomed. And even though it's gotten better, it's still got to get a lot better. And there's no reason that the market shouldn't be the same. Or to your point, Andrew, there's a case to be made for why my market might even be a little tighter in the minis. But the ecosystem is the ecosystem. It isn't just market makers and customers. It's upstairs desks and it's prop firms. And I don't think the upstairs and prop firms are that focused on it yet. And there's where the catch-22 of liquidity begets liquidity is got to come about. So far, the real appetite has been Apple and Spider and little bit of the gold. And I'm generalizing.
It's good for micro adjusting too, for a lot of, especially if people have short gamut trades. I mean, we could talk about it at the end, but I mean, I think the products have convenient uses for types of trades too. So but I can't see like large pro firms really using them in that way. So I think it's kind of, it's 90% of a retail phenomenon, and retail still really isn't back in the market in a big way yet.
Yeah, I agree.
Yeah, it speaks to the, just the nature of the liquidity class right now in the option space and how decimated they have been over the past, 5 or 10 years, and how so many of them, except for the massive ones you cited, Alex, like the Citadels and the Timbers and a few others, so many of them are so careful with their resources. They're not going to flip the switch, and they're not going to develop the infrastructure to trade these things, and they're not going to move into them and devote any sort of really sizable effort toward them until they already see that they are a viable, successful product. So they've just been burned too many times. They've been downsized and slashed and burned so many times that they just don't have the wherewithal to commit to these things until they are a success anymore. And I think that's kind of just the unspoken thing that's playing out in the background here of the minis, is that the infrastructure that should keep these things going and make them a successful product has just been devastated over the past decade. Yeah, it does. It takes money and time. A lot of these firms, most of the small prop shops are out of the business, or most of the small market making firms have either left the business, and now they're primarily prop shops, and they're setting up things like hedge funds and other things, and they're using the market making arm really only as a source of liquidity, so for their own orders essentially, and to lean on. So if they're doing that, they don't have much of a vested interest in going out to the minis for exactly the reason you cited, Andrew. They're too small. They don't get the needle moving for them. So there's a lot of issues, it seems like, lurking within that massively wide spread, and the pricing and everything else. We've talked about the commissions before. That's obviously a factor as well. There's a lot of things that have to fall into place, it seems like, for these minis to make a real dent. But it seems like what we're seeing right now play out in the mini space is very much a symptom of the damage that has occurred in the liquidity providing infrastructure over the past decade or so. And I'll just leave it at that for our listeners to mull over. But hopefully this is not a side.
Example of that.
What was that?
That's why I left. That's why I left the business. One of the biggest reasons is
I think the fact you can see so many people around there with the former. Yeah, so many people around there with the former on that market maker tag floating around Chicago and many other cities and places in the world, including Maine, that you can see. That's another example of why that business is in for hard times. Speaking of hard times, it's time to close out the old trading block and move on into some of the dubious, perhaps exciting, and sometimes dangerous world known otherwise as the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, and welcome to the Odd Block. This is the portion of the program where we break down some of the interesting and or intriguing activity that's lighting up our tape today. If you listen to the recent shows, you know we had some interesting stuff to discuss on Dole and the, shall we say, timely unwinding of a collar out there prior to that big corporate action. And that name, who knows, perhaps we'll have some additional diamonds in the rough floating here in today's Odd Block. And who knows, perhaps this first one here is the name we'll all be talking about in a week or two. Because, of course, when I wake up in the morning, Andrew, I don't know about you, but the first thing I do is I pull up PVR. That is, of course, PVR Partners LP, ticker symbol PVR. They close at $27.22 today, pretty much unched on the day. But that didn't stop them from lighting up the tape from an options perspective, or at least from a relative options perspective. This is the name that does about 400 contracts a day. They did about 1,200 today, and a lot of that coming in essentially one very, very sizable put trade. Why don't you tell us what caught your eye out here in PVR, Mr. Andrew?
You know what? We've had this on the Odd Block before. I'm 90% sure within this last 6 months, maybe, and I think that's the last time the guy rolled. Anyway, customer just basically lifting the offer for a bunch of puts in here. Now, PVR, it's an oil and gas company, and it looks like a very high dividend. Last quarter around 55 cents. They're expecting 55 cents coming up here in August. So it pays a big divvy. It's at an all-year high, probably an all-time high, maybe except for 2008. I don't know how long it's been around. But to me, this looks like kind of hedging type paper. You know, you're buying the NOV 22 puts. You're going to hold on to your capital gains, and you're going to basically let the dividends pay for your puts or something of that nature. That's what I'm seeing. But it doesn't mean the only thing that really went up were these puts. And it was just, sweeping, several exchanges to get them done and have all the hallmarks of just somebody trying to buy some puts when there's not a lot of liquidity around. So.
And it seems like a pretty savvy purchase. If you look at a chart here of PVR, it's been vacillating in this 27 range for a while, but it did dip down back in March to that 22.5 range. Yep. So this trader clearly seeing that and clearly setting a nice floor for himself. We should mention, of course, these are the NOV 22.5 puts that went up about 1,200 times here in PVR for about 75 cents. So this guy paying a substantial premium to get these done, but he likes that level. Looks like he's locking in that floor. Only 192 open on that strike. This is all open in paper. And like you said, Andrew, this is pretty much the only thing that went up today in PVRs. Yeah. This guy had the name entirely to himself. Probably a large, probably, like I said, probably a large underlying holder looking to lock this in. And if he gets some dividends off of it, it pays for some protection. There are worse ways to structure of trade. I think we've talked about quite a few of them on the Odd Block before. So if you can find a nice name like this where the dividends will help pay for some of your protection, it's kind of like almost a built-in covered call. That's not a bad thing.
No, I don't think so. So it seems like it certainly seems like, and there is some open interest of similar size in other months here. Looks like they're kind of rolling up, rolling down sometimes. But just didn't see the other months trading today. So
thank you for that, Andrew. And next up on the old Odd Block, we're going to keep on rolling to a similar narrative type trade, if you will. This is Insmed, great name, Incorporated, ticker symbol INSM. They closed today $12.78, up about 1.5% on the day. And the reason why I say this is a similar trade, and it's just more in the fundamentals of this name. This is the name that does about 200 contracts a day. So like our previous name, PVR, doesn't really let up the tape. From an options perspective, they did a whopping 1,100 contracts today, which for this name is just a ton. The bulk of that coming in some very near-term stuff. We saw a lot of these June 12 halves, really lighten up the old tape. And a bit of interesting story going on behind these. Why don't you run down for our listeners what you saw going up in these June 12 halves today, Andrew?
Well, they went up in 100 lot blocks, which is a lot for this name. And there was decent open interest. Actually, I think this is the strike with the most open interest. So I felt like this was closing paper. The stock is up basically 100% this year. This could be some guy that's been buying calls and then selling them out when they go up. But whatever he made his sale at today, they're trading lower now. So that the sale looked savvy. Volatility is down about 12 points in June. So, whatever the story was, feels like the story has come out and somebody's getting out, but there's certainly not, at least from the open interest point of view, only a portion of the open interest traded today. So, it's a pretty high implied volatility at around 160% for a stock that doesn't move. So, somebody's maybe holding these. The news came out. So I don't think the story, it feels like it's over in here yet because we didn't see the implied vol really tumble. Today was just a tester, a teaser, a little tiny drop in IV. So I guess I'm going to assume here there's another shoe to drop here with this company.
Yeah, they're still waiting for the other shoe, it seems like, out here in INSM. We talked about these types of trades a little bit at our event last month. These are the types of guys who, if you can find them, are interesting to track because if they have a decent track record, it looks like this guy has perhaps been doing this a little bit. He certainly had a decent result, at least on this most recent trade. This is a name that's run all the way from about 8.5 all the way up to about 12.5, 12 3/4 today. So there has been quite a run, and these calls were certainly well timed. And you're right, there's about 1,700 open on this strike. So if this is all the same guy, he's got a lot more to go. Perhaps taking a little bit off the table and seeing what else unfolds before he takes the rest off. But an interesting name on a number of levels. For such a cheap stock, this is a pretty inflated level of vol. Does sound like something else is cooking out here. Maybe another one we'll have to put down in the to watch category to see what else
traded in multiple markets too. So it's always, there's some trying to find some liquidity. That to me is a more aggressive type of seller a trade. Nobody's really taking the other side and they just want to kind of bang it out. So, I think there's always a little bit that to me at least says there's a little more urgency to the trade.
All right. And last up here on the old odd block, we have SRS. This is, of course, the UltraShort Real Estate Proshares. It closed today at $20.77, about unched on the old day. This is another one that really lights up the old tape. This is a 200 contract a day name, doing about 700 today. So really blowing the doors off today. Pretty much all of this, 500 contracts coming in these July 21 puts here, which are pretty much close to at the money puts right now here in this UltraShort SRS name. Interesting activity, pretty much one trade out here in SRS that caught your eye today, Andrew.
I think it was just kind of it. Somebody just went out and banged out the July 21 puts for $1.24. What's interesting about this SRS is this is like the inverse real estate, I think, for the IYR. And it's a 2 times product, but it's had kind of a total launch in value here over the last couple of weeks. So I don't know if this guy, it feels like this was could be a closing transaction. The guy bought the puts when they had, I basically think all those, the IYR and all those REITs felt like they got oversold, bought some of these puts, and now he's banging them out. And again, selling them at $1.24. By the end of the day, they're $1.03 bid. So, again, good timing on the sale. There was more sales as well, probably 300 contracts traded total. That was it. And I think this is, just a piece of the open interest, taking some money, well-timed, short of this thing. I think that SRS pretty close to the top of the range for this thing right now. So, it hasn't seen these levels since, not since, the beginning of the year. So
I always get a bit of a weird feeling when I see big options trades going up, or perhaps relatively big for this name anyway, trades going up on these levered ETFs. These things always leave a bad taste in my mouth. I've called these things for ages the poor man's option. And when you're trading options on the poor man as an option, even though I know they've raised margin requirements and everything else for these things, still it always just it leaves a bad taste in my mouth. You have a lot of clients over there at Option Pit, Andrew, who are trading options actively on not just the ETFs. Obviously, that's a big thing, but these levered ETFs. Or do you try to steer them away from this over there at Option Pit?
Try to steer them away. I mean, we talk to them. It's like, well, if you want twice the leverage, just buy 2 calls instead of buying one.
I love it. There we go. Just buy twice as many. You're all set.
and then you don't have any of the daily drift. But they don't. How do you structure that for people? I try to make it simple, but for most of the part, these products only kind of work because there's usually some sort of funky gamma inside inside these ETFs. So it's like the compounding performance is not great, all kinds of things like that. So the short answer is yes, we try to steer them away whenever possible. Very few of our clients really trade them unless it's like kind of like a one-shot, one-day deal where they feel like, it's worthwhile. But generally, the vol's more expensive in them, and there's no free lunch with them.
Yeah, the margin has been increased now. These things reset on a daily basis. Usually, there's just all kinds of wonky things. Usually, they're constructed pretty poorly, using derivatives to begin with in order to achieve that levered return. So, yeah, they're just weird products all around. I like that answer, though. Just buy twice as many calls.
Well, I think that it's apropos for when we get into the mailbag, at the end of the day.
Indeed. All right, so let's keep on rolling then so we can get to that mailbag. But first, we have to make a little detour into Viceroy land, a.k.a. the Xpress Block.
The Xpress Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, and welcome to the Xpress Block. This is, of course, the portion of the show where the Viceroy takes the reins, and I get to take a little bit of a rest and sip a nice cold beverage here in the hinterlands of Florida. Mr. Viceroy, what have you on the docket for today, sir?
It's going to be a small beverage. We were up all day. This is, again, I'm going to sound boring. It was all the option names. The one name I heard on the desk a lot today was Netflix, obviously, moving over $15. But in a lot of ways, both Andrew and Mike and all of us have talked about this today. It wasn't that exciting of a trading day. Everything was up. Everything was up from the opening. Little schizophrenic there around 2 p.m. But all the traditional names were up. Interest rates, not a lot of movement. Everybody's waiting for Bernanke on Wednesday, and I suspect we're going to have a lot of trading around this range tomorrow. And then Wednesday, if there's any clarity, which often is not the case from the Federal Reserve, we could have a 300 or 400 point day, but not a lot that sort of leapt out today.
Netflix, of course, rallying about $15 or 7% on the day, pretty much off the kitty news. Looks like they signed an exclusive deal with DreamWorks to launch and premiere their animated kids content on Netflix, which actually is a pretty substantial thing. If you have any children floating around the house, you know how popular some of those shows can be. So the fact that Netflix locked some of that down, closing today at nearly 230, we're dancing precariously close to the pre-immolation, the pre-decimation levels of it hit around 300 before it got chopped completely in half. Now Netflix building its way back up. I kind of like the Netflix story just for my own selfish sake. Netflix really showing the value of content in this new era, this new digital era. They kind of got their clocks clean previously because the content makers were dictating terms to them. They were jacking up licensing fees. Now Netflix has gone on the other extreme, creating new shows that it owns entirely. We're seeing Amazon do similar things. As someone whose entire business focuses around creating digital content, that's actually a nice thing to hear and to see, that there still is some love and some value in them there are hills. So Netflix lighten up the old tape today on the strength of Shrek and Madagascar and all those guys. Thank you for that, Alex. We're going to keep on rolling now, right on out of the Express block and right on into the mail block.
Now it's time to empty the mailbag and see what our listeners have to say. It's the mail block.
All right, and welcome to the mail block. This is, of course, the portion of the show where you guys get to take the reins. I don't get to take much of a rest, though, because I have to read the whole thing and then I have to answer. So it doesn't really work out too well for me, but it works out great for you, the listener. We're going to kick things off here with a question from Mr. Dalton Hicks. And he writes, I've just discovered this show, and I think it's fantastic. Well, thank you, Dalton. We all are quite fond of it here as well. Mr. Hicks continues, thanks for all of your great material. I've learned quite a bit. I wanted to write in today to ask about the new strategy I've stumbled upon in my trading. I used to be a covered call seller in individual equity options, but I've recently started thinking about kicking this up a notch by turning it into a, what he puts in quotes, a covered straddle seller. This strategy has many benefits over a traditional covered call. I've never heard this approach discussed on this program, at least not in the recent episodes that I've heard. So I'd like the host's take on this exciting new strategy. Thanks, Mr. Hicks. So yeah, Dalton, this actually is an interesting question. We haven't discussed this to my memory recently on the show, so it actually is good timing on your part. And this is a question we've received variations on from some other shows, and at the website we receive a variation on this question quite a bit because a lot of people do exactly what you've done, Dalton. They start off listening to this show, start off in options in general. They progress a little bit, they become a little bit more sophisticated. They start seeing the value of income generation through things like covered calls, and then they start realizing, wait a minute, I can add an extra kicker to this and sell the whole straddle, and suddenly it's like a light bulb went off in their head and they start jumping on that approach. And so I like how you term it an exciting new strategy. It actually has been around for quite a while. I hate to break it to you, Mr. Hicks, that people have been doing this for quite some time, but we can, of course, give you pride of place, at least to be the first one who brought it up on this show. It's an interesting strategy. I have a take on it. I think it's kind of interesting, but I think first I'll throw out my feelers here. Maybe we'll start with you, Uncle Mike. We haven't heard from you in a while. Give you a chance to chime in here. You obviously have a lot of clients who like to write covered calls and take this type of approach. Do you ever, on either behalf of your clients, or do you have your clients doing this on their own accounts, coming in and adding that kicker, if you will, selling the straddle as opposed to the covered call? What's your take on this?
Well, I think the first thing you need to understand is that let's go back to square one with this. XYZ stock is at 50, let's say, and I want to sell the July 50 calls against it at the money. And then in addition to it, I also want to sell the July 50 puts. So I'm long 100 shares of stock, short one at the money call, short one at the money put. Is that correct? Am I getting that right in terms of what
that's how I've taken it from his email? Yes.
Okay. So with that in mind, I think the first thing that needs to be mentioned on this is just that you have an understanding of what the synthetics are that exist on this. All you're doing is you're taking on another covered call in terms of risk to reward. It's the same, what I just mentioned or what I just went through, it's the same position as having 200 shares of stock with two covered calls. That's all it is. Now, with that in mind, what I think you need to have an understanding of, or the way that I like to look at this strategy, is how does it make sense with how I want to adjust the position, or maybe I want to do a different strike price, something along those lines. So Let's expand on that a little bit. Is the position, the straddle along with the short straddle along with 100 shares of stock, is that better than two covered calls or two short calls and 200 shares of stock? And the answer is no. It's the same position. I mean, yeah, you might get a couple pennies of a skew here or there one way or the other, but from the purest standpoint, it's the same thing. Now, with that, let's say that you're a margin trader and you want to leverage yourself a little bit. Does it make more sense to do that strategy, and you might get a more liberal margin requirement on the short put than you would with buying the stock on 50% margin, let's say? That's another consideration to look at. How do you want to roll this? Let's say that the stock goes up and you get called away on the shares and that put expires worthless. Well, once again, it's the same thing. So I think the main thing that needs to be emphasized is it's the same thing.
I have a couple of horror stories. So one thing, it seems like Option Pit, we're like kind of the repository of people who have misunderstood strategies, and we kind of repair them because we have lots of good traders that come through that just don't understand. Like my classic story is somebody tries one thing over and over and over again with options. And then all of a sudden it stops working. So they do it more and more and more and double up and whatever. And then thinking, of course, that what they were just doing is going to work. So they're like at the blackjack table and they're like, okay, I'll double down, I'll double down, I'll double down, I'll double down. And eventually things get really ugly. So this strategy, first off, like Mike said, short two puts. You're short two puts. So my next question is, do you want to sell two puts? So I always look at things from the risk point of view first when you're trying to choose a position. So it's a great trade if you think the market's not going to really go down, or if the market for the equity is going to be flat or, rising. What we had is we've seen some people, we've had these big sell-offs and they're too aggressive with the strategy, and all of a sudden now you're short two puts and it takes tremendous margin to hold the position on when the market does these, nasty 25%, changes that we had, let's say in 2012, 2011. So then all of a sudden you an account that you thought was up a lot of money, and it was, all of a sudden is down a lot of money really, really fast, because just like we were talking about this leverage ETF, you're essentially having a dual leveraged, buy right. If unless you can handle the risk of a short put in your position and be able to ride, because the only really way that things work out, Mike always says, and I agree with him 100%, if you're going to sell right calls on a stock, you got to want to own the stock. But you could be stopped out on this thing because of the margin requirement, thinking, I've got stock, I'm up money in the stock, but if the thing goes down 35%, now you're long stock, you're getting smoked on, and you have a short put that's blowing up in your face, and all of a sudden your money's gone. So you have to be very careful on this type of position. For me personally, I like selling puts in stocks that have already gone down. I don't think it's a great strategy for stocks that are in nosebleed territory. Let's just put it that way. So, I liked it in Microsoft and in stocks like CHK that had already kind of been in the dustbin. And I think that's it's a company that's not going away, but you've already seen a good piece of the downside. So I say it's a strategy that has a lot more leverage than you think if you're not used to any leverage in a position. So think about that example we just talked about with SRS, the real estate, the dual leveraged inverse real estate trade in the odd block. But that's the idea, right? You got leverage and with potential really bad margins. So you gotta watch the trade. And for me, those are only stocks I only trade that type of stuff in a stock that's already crapped out. It's not something to go chase, a Netflix with. Let's just put it that way.
Yeah,
I want to add to one thing to that. That put just that a lot of times I just remember seeing retail traders doing this from my past, just seeing this. A lot of times retail traders, it's kind of like when we have selective hearing. And we like to think, oh, you can make 20% a month doing options. Well, of course, the selective hearing in us likes to think that. But in reality, if you're trying to make 20% in a month or 10%, whatever the case may be, you need to factor in, well, you can also lose that amount, if not more, in a month. For this trade, my encouragement to you is, number one, if you don't understand what Andrew and I have just said about it's the same thing, a covered call and a cash secured put are the exact same thing. If you don't understand that, you have no business doing this trade. Figure that one out. And you need to come to that realization on your own in one way, shape, or form. Use the trade calculator on Options Express to figure it, whatever you got to do, figure that out. And then the second thing is that short put, it's not a freebie. We like to feel like it's a freebie because all of a sudden we're getting twice as much money for what we were getting a month ago when we start this strategy. But that short put's not a freebie. Remember, you have just as much risk in that as you do in the covered call. That is all.
I'm going to bring a different perspective here, and Andrew and Mike are right. We're talking about the parity transaction, but I want to put on an investor hat, and I want to talk about asset allocation in a portfolio. And I actually consulted on a portfolio that did this for 10 years. And I would encourage Mr. Hicks to go to the SIBO website and look at the white paper on what's called covered combinations. Now, that's not the straddle he's asking about, but it's the covered combination. And here's how to do it. The market, the Dow is at 15,100, and you've got a $100,000 portfolio, and you're running some kind of asset allocation. Let's say you're 60 long and 40 cash. And what happens is the market goes up, you become longer, and as the market goes down, you would like to maintain your asset allocation. So I'm going to make this real black and white. Let's say I want to be 60 long and 40 cash, and let's say if the Dow goes to 16,000, I want to be 80 long and 20 cash. Okay, now I know I'm making this a little sophisticated, but this is all about the psychology of investing. And what you're doing in the covered combination is you're selling into rallies, buying into dips, and getting paid to do it. And the whole idea is to manage money. So what you're doing when you sell the combination is you're identifying points at which you would exit the market and points at which you would add to the market. So to both Mike and Andrew's point, you don't just do this blindly. Buy the 1,000 shares. If you got $100,000, buy the 1,000 shares at $100 and sell 10 straddles. Instead, what you do is you buy, if you want to be 60 long, you buy 600 shares of the $100 stock, and you sell 6 calls and you sell 4 puts. And if the market goes up to your target in the stock, you're out, you're in cash. If the market goes long, you've bought on the dip. And talking about parity is important, and it's important to understand that this is just 2 puts, but it's also from the standpoint of asset allocation, creating a sell point at which I want to exit and getting paid to exit, creating a buy point at which I would be comfortable buying more, and to Mike's point, not over leveraging. If you're going to over leverage, no strategy works. But think about this from the standpoint of buying low and selling high and hedging in the middle. And where this is most appropriate is an investor who wants to generate cash flow, because what they're doing essentially is, take the Microsoft example, saying, look, I'd be out at 40 and I'd be a buyer more at 25. Now, maybe those are extreme numbers, but if I own 500 shares of Microsoft and I've got the equivalent of 500 shares in cash, I can sell options that would take me out at my upside target. I can sell puts that would add to the position at the downside target. And essentially in the middle of the market, I'm hedging. So I'd encourage Mr. Hicks to go to the SIBO site and download the white paper of the covered combination. There's a longer conversation about is it better to write straddles or combos or straddles, and we don't have the time to do that today. But in a world of zero friction, which is a world that doesn't exist, you would always write straddles as opposed to writing strangles or combos, depending on the language you use. But that's a conversation for another day.
Well, Mr. Hicks, judging by the response, I haven't even had a chance to jump in yet. We've already had some great conversation on this. So judging by the response, this is certainly a fertile ground. Great question. Thanks for writing in. Maybe we'll pick this up again on another show. But unfortunately, now we have to keep on rolling right on into our final segment, Around the Block.
Around the Block.
All right, and welcome to Around the Block. This is, of course, the portion of the show where we talk about what we're watching for the rest of this week, and I think all of us are pretty much on the same note here. We're pretty much, there's one thing to watch this week, and that is the Fed coming up on Wednesday. Andrew, anything else you're keeping an eye on aside from our friends over at the Fed?
I do like this story about the transatlantic free trade type thing. Again, anything that I think adds to my thing about the market's real simple. Anytime you see stability, confidence building things on the big picture, I think is always bullish. Anytime there's anything that destabilizes the market for whatever reason, we tank. And I just like Alex, great ideas. I always like having some cash around when the market goes in the ash can. So I think we're going to have kind of that this week. We'll probably have a couple of ups and downs. And I think Bernanke, we wait. That's because that's what we're going to see. Now I wonder what the headline is tomorrow. What happens overnight in Japan, and maybe we'll be down, 0.75%. Who knows?
All right. And Mr. Tusaw, what are you watching for the rest of this week outside of our friends over there at FOMCA?
Nothing to watch, really. So, yeah, I'm pretty much laser focused on the Fed right now. I just want to make sure that all my positions are set up just the way I want them to tomorrow. And I might do a couple of things on Wednesday morning, but for the most part, tomorrow, making sure all the positions are in line and getting the popcorn ready and seeing what Uncle Ben has to say.
So essentially blasting out a bunch of straddles on Tuesday night and then getting ready for Wednesday, right?
Well, and that leads me to the promotion of my new book. I don't mind taking on more risk so long as I make money.
There we go. Everyone's got new books coming out. This is a very active panel we have going on today, putting out books left and right. Very esteemed, many authors.
That's a direct quote that I got from a client one time. So
really?
That's just what it made me think of. I say, well, that takes on more risk. Well, I don't mind so long as it makes money. And he was serious.
That's a wise fellow. Hold on to that client, sir. Cling to him for as long as possible.
He's a very nice man, actually. But anyway.
All right. And last but certainly not least, Mr. Alex, what are you watching for the rest of this week, sir?
The Fed. And if there's clarity from Bernanke that easing is going to continue, we could have a 300 or 400 point up day or a couple days. But there's rarely real clarity from the Fed. So I think it's going to be nuance of what he says and what he doesn't say. And if there's no clarity, we're going to live with 100, 150 point plus or minus days for a while.
I think everyone's in the old macro realm that you've been in for a while now, Alex. Everyone's playing the macro game as we all watch the Fed and see what's going on with this cross-Atlantic trade deal that Andrew was referring to as well. A lot of macro stuff in the air for at least until Wednesday. Then we'll see what's going on going forward. So perhaps Thursday's show could be very exciting or perhaps very boring. Depends on what unfolds on Wednesday. But we'll stay tuned for Thursday's show. We can all find out together. But unfortunately, that's all the time we have for today's episode. But before we go, I do like to check in with my cohorts here, my partners in crime, to see what they're cooking up over there in their respective necks of the woods that may interest you, the listener. Starting off with you, Andrew. What is cooking up in the realm of OptionPit.com?
It's coming to Pit, Option Pit Boot Camp, not to be confused with other boot camps, where we talk about volatility and kind of hit the high points of, subjects I think you should know how to do so you can actually understand what we talk about on this show all the time and be able to create trades, positions, and, manage your own money for yourself, but understanding how options work instead of having to guess how they work. So that is next week. Go to optionpit.com/events and sign up for the Option Pit Bootcamp.
And don't forget Andrew's upcoming book, The Joys of Selling Covered Straddles, coming to a bookstore near you very shortly.
It's a great trade in an appropriate environment, but most of the time, the best time to do it, nobody wants to do it.
Exactly. All right. Thank you for that, sir. And Mr. Tusaw, what is going on in the land of the RCM webinar train? Is it pulling into a station near me anytime soon?
It is. Well, it depends on which time zone you're in. But wait a minute. That's the magic of webinars that can go anywhere. This Thursday night, we are going to have Jerry Woolert from the Rebound Rabbits coming and talking to us about his various strategies, and we're excited to have him. He is a first-time guest on the RCM webinar train.
The Rebound Rabbits. I like that. I'm not sure if I like that name or if it's horribly appalling, but either way, it's memorable, so I guess that works.
It'll give you nightmares. You're gonna see stock quotes and pink rabbits going across your tonight when you go to sleep.
Well, thank you for that, sir. And last but certainly not least, yet again, Mr. Alex, you keep coming up last. I'm going to have to rotate you into the mix earlier in future segments. But what is cooking over there in the land of OX, Mr. Alex?
Just showcase a couple webinars. Wednesday at noon, trading futures. And for those listeners who haven't looked at futures, and especially futures options, the futures options business now is growing at a much faster rate. The equity option business, still the exciting core of our business, but a little difficult period the last couple of years. Futures options growing like a rabbit. So bunnies there, especially if you're looking at the energy products or the metal products. And then Wednesday afternoon at 3:30 Chicago, we're going to showcase a lot of the new features on the site, including the walk limit, the idea hub, the new streaming charts, the volatility on charts. Towards the end of this month, beginning of July, we'll have minis in the charting programs. So a bunch of new stuff coming.
Yes, futures options certainly seem to be the trend right now. Of course, our friends over there at RCM and our friends over at Market Taker just joined forces to launch a new futures options series over there. And we have another futures options show cooking in the old hopper here. Should launch sometime, hopefully this month, if we can get all of our ducks in a row. So yeah, futures options very much on everyone's mind these days. And we're looking to add some more content to deal with that increased interest in that land of commodities and metals and all sorts of fun stuff. And speaking of fun stuff, I want to remind you all to check out the new shows we have going on over there at the Options Insider Radio Network. A lot of you love the old Options News Rundown, where we've added the wide world of options to that as well. And hopefully we should have this Futures Options show kicking into the old hopper sometime in the upcoming month. So a lot of great new content heading your way. And of course, we want to thank all of you out there for downloading and streaming and subscribing to this program and all the other programs on our network. You guys have really just been devouring our content of late. So we love it. We're hoping to make more for you to keep up that pace, because the network has just been exploding. And all of that is, of course, thanks to you. And we'll see you next time right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting, and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.